Now, let's look at the most basic Fibonacci strategy. And this strategy is used by many professional traders. Many professional traders use Fibonacci levels to determine the timing and or direction of their entry. And so all we do is we draw our fib line, and we'll use the uptrend from this low to this high. And what we want to do is, after the end of the uptrend, on the pullback, on the correction, we want to wait for price to touch the 50% Fibonacci level. And we would enter long here. And the reason why we would enter long here is because we want to trade in the direction of the prevailing trend. And as long as price has not closed below the 61.8% Fibonacci level, it is to be assumed that the current uptrend is still in effect. So price began an uptrend down here and moved all the way up here and fell back to the 50% Fibonacci level here, and as we can see, we had a nice bounce off of the 50% Fibonacci level. That's about 70 pip bounce off of the 50% Fibonacci level. And when you start playing with this Fibonacci in this way on your chart and looking back on your chart, you will see that this happens time and time again. And how professional traders usually take advantage of the Fibonacci laws and tendency of the market is that what they will do, and which is what I suggest that you also do, is that they will buy at 50%, but when they buy, they will only take a partial position. They will not take their full position. And they will also buy at the 61.8% level. So on the correction back down, we enter long at 50%, and if price should continue down, we would enter another long here at 61.8%, and then this line here is the 78.6% line. And that's the simple strategy. In an uptrend, you draw your line from the low to the high, and you enter in the direction of the trend at 50% Fibonacci, and you enter a partial position, and you enter another position or the rest of your position at 61.8% Fibonacci. And this is known as scaling into your position, scaling in. And the advantages of this is that, for one, if you get a pullback to 61.8%, now your effective entry price has also lowered. So for instance, this 50% is around 56.85, and the 61% right here is at around 56.70. So that's a 15 pip spread between 50% and 61.8%. And so we would divide that 15 in half and come up with an effective buy price of around, instead of 56.85, it would be around 56.80, somewhere in that area, just going off the top of my head. I'm not one of those math geniuses. But now let's see what it looks like on our bar chart. Okay, on our candlestick chart here, and here's the beginning of our up move here, and we draw a fib line to the top here, and we see the retracement or the correction pullback, whichever you want to call it. Okay, we come down here, 50%. Okay, and if we buy here, we get a nice bounce back up. Okay, probably about 40-50 pip bounce back up. We come back down, we bounce off of 50% again and get another nice bounce up. Looks like about 80 to 100 pips, and it's just that simple. Draw your fib lines, low to high, place your limit order, or watch the market and wait to see what the pattern is looking like when it does touch 50%. In any event, you can just place your limit order to buy at 50% and a second limit order to buy at 61.8%. And later on, we'll be getting into where you want to place your stops and your profit targets based purely on Fibonacci. Okay, let's look at what we would have if we look at a downtrend. Let's take this down move here. Now in the down move, we start from the high and draw our line down to the low. Okay, now we look here and see that price fell down in an impulse move, and so now the trend is also down, so we want to look for a retracement back up. We want to look for a good entry to sell short when price moves back up. And we can see here that on the way back up, price did not stop at 50%. If we were trading our Fibonacci method, we would be entering short right here at 50%, and then we would be entering short again right here at 68%. Now I know that the move did continue up past our entry levels, but it did not move up past our stop. Okay, because our stop really needs to be above the 100% level, or the last high, or the beginning of the move. But now this level here, this 78.6% level, this is the important level that sits between the 61.8 and the 100% level. Many traders are not really aware of the 78.6 level and how important it is, but it's very important in the currency markets, not so much as other markets that I've noticed, but I've noticed that the currency markets honor this 78.6% level quite frequently, and I believe it's because the market operators are more active. From my experiences, I've traded currencies, stocks, bonds, metals. I've traded all the markets, and it often seems that the currencies are the most manipulated, and because of that, operators know about Fibonacci. They use it themselves. They know about it very well, and they know that many professional traders will use this Fibonacci technique as far as timing their entry and where they want to get in. And they also know that 61.8% is that maximum level where they want to go. And so many times they will sneak price up to that 78.6% level, or down if it's on a down move, or an up move, I'm sorry. And then price will reverse. And so that's important to know. And now let's talk a little bit about where we would want to exit. So now you have the basic Fibonacci strategy, and you understand how we want to be looking at the market as far as the Fibonacci structure. And by using the Fibonacci structure, it will keep you on the right side of the market most of the time. And as I always say, I often say that the best value of any method is not necessarily the trades that it gets you into, but it is the trades that it keeps you out of. So now that we have the basic strategy down, next we're going to talk about the nuances and more about trading inside of the 50 and 61.8% range, the little nuances of Fibonacci and how it actually moves. So I'll see you in the next segment.